Hey, what's up, guys? Sam here, and today we're going to be covering multiple aspects of how to utilize options based on how they work. So we're going to be doing a comprehensive look, ideally from top to bottom, bottom to top, around how options work, why we use them, and different situations in which we use them. So let's dive in. So why trade options? Have you ever wanted to trade an expensive stock, but the stock is so expensive that it's hard to buy enough shares to make a decent profit? The reason we like options is because one options contract lets you control essentially 100 shares of stock. So, for example, let's say you wanted to buy Netflix stock. Netflix stock right now is about $400 a share. 400 times 100 is about $40,000. If you have a larger account, that's not a big deal, but if you have a smaller account, and by this metric, it would be an account probably less than $500,000, which applies to a lot of traders, then trading the options on something like Netflix would allow you to play the same type of move for significantly less initial investment. So, for example, a call on Netflix representing those same 100 shares might only be $10, right? Which would be the equivalent of, let's say, $1,000. So, with $1,000 in an options contract, you can now control as much as $40,000 in 100 shares of Netflix. So, just a brief reason why we like the leverage that's offered to us by options. That's not the only reason we like options. We'll get to those reasons in later sections, but the leverage certainly is a big component of it. So why trade options? Let's say that Tesla is an $800 stock and you think that Tesla is going to go up and you want to be a part of that move. Very much like we said in the previous slide, 100 shares of Tesla stock in this situation would cost you about $80,000. Or you could buy the same option representing the same 100 shares for around $2,500. So you can see there the levers that could be employed with this strategy. So how to use options, how to utilize options to place trades. Trading options offers traders a way to use leverage to amplify their exposure to a stock with less capital requirements than buying the stock. Because of that, we want to understand options thoroughly so that we may have as much edge as possible when trading. In the following sections, we will cover the basics of options trading as well as some of the tips on improving our success rate as traders. So long versus short. Long is the same thing as buy. Short is the same thing as sell. If you're bullish on a stock, you want to go long or buy it. If you're bearish on a stock, you want to go short or sell it. Options in a nutshell. Very bare bones interpretation of options. If you think that a stock is going to go down, you buy a put option. If you think that a stock is going to go up, you buy a call option. Types of options contracts. The buyer has the right to buy the stock at a specific price, known as the strike price. The seller has the obligation to sell the stock when they have sold calls at the agreed upon strike price. The buyer, in terms of puts, has the right to sell the stock at the agreed upon strike price, and the seller of puts has the obligation to buy the stock at the agreed upon strike price. Bullish versus bearish. So if you go long calls, long means bullish in this situation. Long calls, trader is buying the option and you're hoping that the underlying stock goes up. If you're buying puts, you're long puts. In that situation, you're buying the puts with the expectation that the underlying stock will go down in price. The flip side is you can also sell puts as opposed to buy them. When you sell puts or you short puts, that has the same effect as being in a long position in the stock. Essentially, you are long the stock, and the trader is a seller of the option with the intention that the underlying stock will go up in price, and they can keep the credit from the puts they sold. When you're short calls, the trader is a seller of those calls, and they are doing that with the intention that the stock will go lower, so that those calls that they sold, they are able to then keep the full credit for those calls. Buyers, long, options buyers pay a debit to control the long option until expiration. They are buying the right to purchase a stock at a certain price in a way that limits their risk. The goal is to utilize leverage to profit on a move in the stock. So when you buy, let's go back to our Netflix example from earlier. Let's say you buy those 100 shares of Netflix at $400 and it costs you a total of $40,000 to do that. There is a theoretical situation in which Netflix could go out of business tomorrow. And Netflix could open, low probability, but not zero. Netflix could open tomorrow at exactly $0. Well, in that situation, your 100 shares are now worth zero. And if you did shares, you're down $40,000 on the position. However, if you have calls on Netflix, and let's say that call is $10 or $1,000, then if the same thing happens and Netflix were to open at zero tomorrow, then you would only lose the initial $1,000. So when you buy a call option, you are limited, your loss is limited to the cost of the option or the debit paid. Option sellers sell options to collect premium. They take on the obligation to sell the underlying stock to a buyer if the buyer decides to exercise their option. The goal is to sell options that will lose value so they can profit. Now we'll cover this a little bit more detail in later sections, but essentially it's the reverse. So when you sell an option, theoretically your risk is actually unlimited. Of course, this is theoretical risk, but it is technically unlimited. In the same way that if you sell the call on Netflix, and let's say that Disney buys them out at $2,000 a share, well, all of a sudden it is entirely possible that you could lose more than you put in. So there are trade-offs to both sides, which we will cover also in later sections. The type of strategy you use depends on your overall analysis of the underlying chart, your risk tolerance, and your preferred strategies. In this section, we're going to cover why options change in price, and we're also going to do an introduction into the Greeks. Why options change in price? Multiple factors affect the price of an options contract. As options traders, we are mostly interested in the three factors that change the value of an option: the direction of movement of the stock going up or down, the passage of time, and also changes in volatility. All the things that we just said, the movement of the stock, the passage of time, the change in volatility, they also have Greeks symbols that represent each one of these. So why do options change in price? The three primary Greeks. Delta refers to the directional movement up or down in the stock. The higher the delta, the more that the option price will change based on a $1 move in the underlying stock. Theta refers to the passage of time, which causes the decay of options values. So as time progresses, as it tends to do, then the theta is how much the options contract is losing every day. Keep in mind that if you have a call or a put, you are constantly facing theta, meaning that each day that passes, a little bit of that value of the option is decaying, which increases as you get closer to expiration. And then the last major Greek that we want to care about here is going to be vega, or changes in implied volatility. So let's go over each one of these individually. First, we're going to start with delta, which is, again, directional movement. So delta refers to the price change of an option depending on the directional change of the stock. Delta is shown as a .xx value, where delta represents the amount the option will change based on a $1 move in the underlying stock. So what does that mean? It means that if you have, let's say, a delta 70 call or a delta 70 put, which is usually kind of the rule of thumb that we go with. If we're going to get long an option, we usually try to go with delta 70 just as a rule of thumb. But let's say that you have a delta 70 option and the stock were to rise $1. If it's delta 70 and the stock rises $1, the price of that options contract has changed by 70 cents or $70, in real life dollars, as opposed to 70 cents in options dollars. So the delta represents the dollar movement per $1 change in the underlying stock. If it's a delta 50 and the stock moves $1, the options price will move by 50 cents, etc., etc. So John's rule of thumb is if he wants to buy a call or a put, he will usually look for a delta 70, as it is a good mix of being in the money as well as capturing directional movement. A delta 70 call option will increase 70 cents or $70 for every $1 move in the stock. If we buy a delta 70 call option and the stock moves $10, we can expect the option value to change $7 or $700 total. Delta 70 times $10 equals 700 or $7 change in the price of the option. Next, we're going to talk about theta. Theta is the same thing as time decay. So since options have an expiration date, the more time that goes by and the closer an option approaches its expiration date, the more the option loses value. So the closer you are to your expiration date, the faster your theta is going to decay. Traders who sell options, however, benefit from this theta decay because they capture the decreasing value of the option over time. So that's probably the first kind of wrinkle in what we've covered so far, and that is if you are a buyer of calls and puts consistently, you are always facing the theta monster, right? The theta decay is always kind of wind in your face, right? The price of the option, the price of the stock has to move faster than the theta decay. However, if you become an option seller, that theta decay actually works in your favor because now you sold something to somebody else that is decaying, and every day that passes, as long as the stock doesn't move beyond the expected move, you are actually taking that money in as premium. So a little bit of a wrinkle there in terms of theta exposure on both sides. Here's a graph of theta decay, just so you can understand how quickly it shifts closer to the expiration. Usually about 120 days out, you're going to have the least amount of theta decay. And then once you get into about under 30 days, you can see how steep that curve gets, and you start to have very rapid theta decay. So if you're going to be a buyer of options facing theta decay, you typically want to do it a little bit longer out. And if you want to be a seller of options and really capture the theta decay quickly, you want to do it shorter dated. Vega is the Greek for implied volatility in this case. Implied volatility represents the market's expectation of future volatility in the underlying stock. An increase in IV, implied volatility, equals that the options tend to increase in price. So if the implied volatility is going higher, that has a positive effect on bought calls or bought puts, because IV or Vega is an input into the option's price. If the IV goes up, the option will tend to increase in price, all other things remaining constant. The same thing is true for a decrease in IV. So if implied volatility were to decrease, options prices tend to also decrease. Higher volatility increases the likelihood of fast price movements, which can increase the potential value of a call or put. So think of the difference between something that has traditionally high volatility. Maybe you think of something like Tesla versus something that has traditionally low volatility, something like maybe utilities. So here's a graph of the implied volatility curves, and you can see there that the Vega is the highest as you go a little bit further out, and Vega is the highest at the money, which is usually going to be a delta 50 call or put, but at the money means whatever strike the stock is trading at, that's at the money. That tends to have the highest implied volatility. So let's tie it all together. Now that we have an understanding of the three primary Greeks that affect the value of an option, let's tie it all together. If we think a stock is going to go up rapidly, we want a strategy that is high on delta and Vega. Delta being directional movement, Vega being implied volatility. If you think that a stock is going to go up very slowly, then you want a strategy that is high on theta, right? Because you want to be able to collect some premium as the stock is grinding slowly higher. In this section, we're going to cover premium decay. Premium decay refers to the loss of value of an option over time. This is usually measured with a negative value of theta. The higher the negative value of theta, the more and faster the option will be decaying. Call or put buyers will view this as a negative, as the value of their options will be what is decaying over time. Call or put sellers will view this as a positive, as the value of their sold options will decay, and that money is in their pocket over time. There are times when you want to be less concerned with premium decay, and then there's more often times where you want to be very concerned with premium decay. If you are a short-term, very directional trader, this won't affect you that much. However, your probability of success will tend to be significantly lower than if you are a premium seller. So premium sellers tend to have less maximum reward, but significantly higher probability of success. So premium decay, theta burn. Since options have an expiration date, the more time that goes by and the closer an option approaches its expiration date, the more the option loses value. Like we've covered, traders who sell options benefit from this theta decay because they capture the decreasing value of the option that they sold over time. And again, there's that graph showing you that your fastest decay, which is a negative if you're long premium and is a positive if you're short premium, occurs right around that 30-day window. In this section, we'll be covering the differences between buying versus selling premium. So options premium is the cost of the options contract. Basically, how much do you pay for it in total, with everything factored in. The option premium is the fee the option buyer pays the seller when the options contract is purchased. It represents the potential profit or loss of the trade depending on the future movement of the underlying stock. Options premium is determined by various factors, including the current price of the underlying asset, the strike price, the expiration date, and the implied volatility of the underlying stock. Credit versus debit. So we've covered this briefly, but this is a very important thing, so we'll continue to cover it. Credit refers to receiving money, premium, when opening a position. When you sell an option contract, you receive a premium from the buyer. Selling options with credit can be profitable if the option expires worthless or if the premium decreases over time. Debit refers to paying money to open a position, as opposed to receiving a credit. When you buy an option contract, you pay the premium to the seller. Buying options with a debit can be profitable if the option increases in value and then you are able to sell them for a higher price. Options premium is determined by various factors, including the current price of the underlying asset, the strike price, the expiration date, and the implied volatility of the underlying asset. However, market makers factor in the expected move of the underlying stock into the options premium. This means that unless the option moves outside of the expected move, the buyer or the holder of the option has a higher probability of expiring worthless. So as we go through this, the main takeaway is that options premium buyers, so those folks that are just buying calls or buying puts, over time their probability of success is going to be considerably lower than premium sellers. The reason being is that they have to overcome multiple factors. They're overcoming the theta decay. They're also having to have the stock move faster than what the market has already priced in, whereas option sellers benefit from those two things. So options traders can either buy or sell premium. When you buy premium, traders buy premium or pay a debit. They are purchasing the options contract. When traders sell premium or receive a credit, they collect the premium upfront and aim to keep the premium or the credit as profit if the option they sold expires worthless. Some of the pros of buying premium, pros and cons. Some of the pros are that it has a higher profit potential. It has defined risk in that the loss is limited to the cost of the option. When you buy premium, you're not able to lose more than what you put in. And you also get the additional leverage provided by buying the premium. Some of the cons of buying premium are the time decay that you will face, that the fact that they have a higher break-even point, and a much lower probability of profit over time. Selling premium. Pros of selling premium: higher probability of profit, time decay advantage. It can provide a more consistent income stream than buying premium. Cons of selling premium: you can have moments where you have unlimited risk. You have a limited profit potential, and it also requires larger margin requirements. Buying premium. Some examples of strategies that are considered buying premium are going to be simple calls and puts, or debit spreads, or verticals. Selling premium. Examples of strategies that are considered selling premium are selling naked calls or puts, selling credit spreads or verticals, butterflies and unbalanced butterflies, which are more advanced topics, and ratio spreads, which again are further more advanced strategies. In this section, we'll be covering the impact of volatility. So volatility, or vega, is how much a stock or index moves up or down over a given period of time. The higher the volatility, the more the stock or the index will move around up and down, and the lower the volatility, the smaller the movements will be on the stock or the index. Volatility is important because it represents the chance of a bigger move and thus it affects the price of the options. The up and down movement in dollars is expressed in percentage terms on an annualized basis. This rate of movement is the volatility of your stock or your index. So for example, if Google has a volatility rank of 40%, this means that mathematically Google has a chance of being 40% higher or 40% lower in price. Historical and implied volatility. There are two types of volatility. Historical volatility is that which has happened in the past, and implied volatility is volatility that is expected to happen in the future. To understand if volatility is high or low, it depends on where it has been trading over the last 12 months. Is the current implied volatility higher than its historical volatility? So we all kind of know this intuitively. The example that we used earlier was Tesla versus a utility company. Right off the bat, you could probably guess that something like Tesla would have a higher implied volatility than a utility company. That is why you see Tesla have large moves, or technology stocks in general have very large moves. Whereas something like utilities or maybe staples, Coca-Cola, Pepsi, things like that, will tend to have smaller moves. That all gets baked into the price of the option. And so the goal is not necessarily to say this has high volatility relative to something else, because we can already kind of figure that out. But the idea is whether the implied volatility is high relative to what it has been for that stock in the past. The volatility index, otherwise known as the VIX, is somewhat different. The VIX is an index which measures the expectations of fluctuations in price of the S&P 500 over the next 30 days. The VIX is also known as the fear index. Why is it sometimes called the fear index? Generally, if the VIX is higher, this indicates that investors expect the value of the S&P 500 to fluctuate up and down, or both, in large measures over the next 30 days. A high VIX usually means uncertainty. Lower VIX usually indicates calmer markets. Premiums will go up when you have a higher VIX in general, and premiums will come down when you have a lower VIX also in general. The term fear index is not always accurate, however, because you can still have an elevated VIX when fear is to the upside and options are being priced higher. So it actually cuts both ways. A higher VIX means that large moves are expected, and those large moves can be up or down. Low values for the VIX would be something like 16 or lower, and would be better for premium buying strategies. So when the VIX is lower, below 16, the lower the better for this. The less advantage you give up when you buy premium. You will always give up some advantage when you're buying premium, but if you can do it if you can buy premium when the VIX is low, that is usually the better way to do it. High values for the VIX would be something like 20 or higher, and those would be better for premium selling strategies because it gives you even more edge on top of what you already have from the natural advantage of selling premium. Next, we're going to be covering how to select stocks for options trading. Selecting stocks for options trading. There are many considerations to keep in mind when identifying which stock to trade. Liquidity, volatility, implied volatility and historical volatility, the trend of the stock, and the trend of the sector, as well as the broader market itself. Let's first talk about liquidity. Look for stocks with high trading volume and open interest on their options contracts. I like to look for 100 open interest per one contract that I intend to buy or sell. So if I intend to buy 5 calls, I would look for something that has at least 500 open interest at that strike. This helps with easier entry and exit points, as well as with tighter bid-ask spreads and reduced slippage. Many advantages to trading highly liquid stocks. Volatility. Stocks with significant price fluctuations and higher volatility generally lead to higher options premiums. For example, tech stocks will tend to have much higher volatility and faster moves than something like drug stocks, which will tend to move much more slowly. Upcoming events like earnings reports and major news announcements also increase volatility. Compare the implied volatility with the historical volatility. If the implied volatility is relatively high compared to the historical volatility, the options could be priced at a premium due to market expectations. Traders can then take advantage of this by selling options with the higher premiums, which will further give you additional edge or advantage when you are trading these types of stocks. Also trend. Trend is incredibly important. So we take trend into account. The trend of the stock is very important as we usually want to be trading in the direction of the trend. Trade with the trend to increase your probability of success. So as we go along, you'll start to put the pieces together that if you're trying to increase your probability of success as much as possible, you will typically be selling premium. You'll typically be selling premium in something that has a trending stock, and that also will have a trending sector and ideally a trending market. And then when you are able to do all of that, you've really put a lot of advantages on your side. So when we look at the chart of the QQQ on the right, for the past number of months, the trend has been strongly up. You can notice that here in the moving averages, even if you don't use any other indicators. The moving averages are very angled. They're stacked, meaning that the fast one is on top of the slow. And you can see that it's actually holding on the moving averages. These are the types of situations in which we want to be participating in, because trends tend to be the easiest and most reliable way to make money in the market. Therefore, we want to stay focused on having positive deltas in this particular uptrend, being long, and from there decide if we want to be long premium for big moves out of squeezes, or short premium for sideways to slow moves higher. So when you are in an uptrend and you have a squeeze, buying that Delta 70 call is a little bit more forgiving than buying a Delta 70 call when you don't have a squeeze, because the squeeze implies that a big move is coming. If you don't have a squeeze but you have an uptrend, then usually selling the premium will give you the biggest advantage. Next step would be something like sector analysis. So this means that if I want to buy a stock, in this case let's say Caterpillar, I should not just review the chart of Caterpillar and then make a trade. I think in that situation I would be missing a big component of what's going on. So I can increase my probability of success greatly by starting at the top with the index, so something like the S&P 500, then the sector, in this case it would be industrials, and then finally the stock. Once I've confirmed that the S&P is in decent standing, then I've confirmed that the industrials, the XLI, is also in decent standing, then I can then take action on the setup that I see in Caterpillar. So to go back to that, I want to look at the index, SPY, or the SPX, the sector, XLI, and then the stock, Caterpillar. If all three are aligned, we have a good, high-quality trade. When we do this top-down approach, our probability of success on a trade will increase considerably over time. So in this section, we're going to be covering strategy selection. Strategy selection implies the analysis of the individual ticker plus the addition of trading it via options. So it is combining finding the right thing to trade and then finding the right way to trade that thing, the right strategy to trade that thing. Number one, we want to identify the stock that we want to trade. Number two, we want to identify the setup using our charts. Number three, we want to decide how to trade it based on what options are available to us. So this is my strategy cheat sheet. So the best trade strategies have full alignment. What is full alignment? Full alignment means that the moving averages are correctly positioned with defined angle and trend. We looked at an example of that in the earlier slides when the QQQ, when you had your fastest moving average on top of your slowest, as well as they were angled upwards to indicate an uptrend. Also, we want to have our momentum indicators aligned in the direction of the trend. So it doesn't really matter what momentum indicator you use. There are many out there, including some made by Simpler. But you want to have the momentum indicators confirming what you are seeing in those moving averages and in price. And then the third thing, and probably the most important, is we want to make sure that the market index, the S&P 500, the NASDAQ, wherever we happen to be trading, and the sector are aligned in the same direction as the stock. That's very important. Keep in mind index, sector, stock. So what strategies do we implement when we have full alignment? When we have all three of these things working in our favor, we have a very high quality setup. What strategies do we want to implement for that? Well, in that situation, if we have everything going for us, we can go ahead and buy those calls and puts, and the rule of thumb is going to be Delta 70. We could also buy debit spreads, which is a same concept, but it has less risk, less reward, and less theta effects because you're buying something and you're selling something. So in that case, we'd be buying a debit spread. We could buy any call for a long, let's say between delta 50 and delta 70, and then we would short another call in the same series. That would be something like delta 30 to delta 20, creating a debit spread. Our third option would be wide or out of the money butterflies with the center strikes placed at resistance. So notice in this instance, we're talking about out of the money butterflies and making them wide, so that way when the stock, because it has a very high probability of success due to having full alignment, as that stock moves into where we place the butterflies, you can get pretty rapid returns that way. So in this situation, when we have full alignment, we want to prioritize higher deltas, and we're less concerned with maintaining positive theta, although theta is always a bonus. So in the ideal situation, we can be a little bit more aggressive using these strategies. Let's say that you have messy alignment. What does messy alignment look like? Well, you're going to have sideways moving averages, especially the 50 and the 200 SMA, and you're going to have messy momentum indicators showing either neutral momentum or conflicting momentum. Well, you'll have some time frames that are bullish, some time frames that are bearish. When you mix bullish and bearish together, you get a mess, and that would be messy alignment. What strategies are best for this? Selling credit spreads is probably the most favorable bread and butter strategy for most. You can also do in the money normal butterflies, standard butterflies. You can also do iron condors. You can also do unbalanced butterflies. Those are going to be more advanced. And lastly, you could do ratio spreads, which are also advanced. When you have messy alignment, you want to prioritize theta positive, delta minimal strategies because it's messy. And so as things get figured out, as it chops around in a box, you want to be able to take advantage of that, and you do that by having a very high theta exposure with minimal delta exposures. So here's my pre-trade checklist. Make sure you know how the indexes are positioned, number one. Make sure you know how the sector of your stock is positioned. Tides before boats. So remember index, sector, and then lastly, stock. Index, sector, stock. Make sure you know whether the VIX is closer to resistance or support, as volatility will affect pricing of things market-wide. This weekend, try and do some macro analysis on your own. Concentrate on SPY, QQQ, whatever sector you are trading, and then your stock. Make sure that everything is in harmony before you trade. Before every trade, we must have a checklist of technical signals for why we are taking the trade. Do you have stacked moving averages? Is there a squeeze that's ready? What do your momentum indicators say? Is it in trend or is it neutral? Does the stock look better than the index and the sector that it is in? If you're trading a stock and it looks better than the index and the sector that it resides in, that is going to be a good situation usually. Is the VIX near support or resistance? And these are just to name a few. Once you have your own indicator-based checklist, that's the first step towards higher probability trading. So in conclusion, now that you have an understanding of what we are looking for when trading options, you will be able to gauge whether you want to be a premium buyer or a premium seller. Keep in mind that premium sellers will tend to win more often, as well as knowing what to look for when it comes to liquidity, volatility, and stock selection. You are now ready to build your own plan in order to increase your probability of success on every trade.